Investors with over $100 million in assets are called super investors, and thankfully the government requires them to reveal their portfolio movements every quarter. And so first of all, we will jump to Warren Buffett's portfolio, the Berkshire Hathaway, and we can have a look at the portfolio movement on the first quarter of 2024, and we can see that he has actually reduced his position in Apple by almost 13% and in CVX or Chevron by about 2.5%. But we can also see that he has increased his position in OXY by 1.77%, and now it makes up almost 5% of his portfolio, being in the top 6 companies in Warren Buffett's portfolio. Now, if we click at the 3 lines over here, we can see the movement of OXY specifically for Warren Buffett's portfolio. So we can see that he mainly bought the company in 2022, and since then he has actually been adding to this position all the way up to the current time. And so now let's jump to my stock valuation spreadsheet and evaluate OXY using the Mettler analysis and figure out its intrinsic value using our 4 valuation methods. So first let's jump to the stock screener and plug in the ticker OXY, and all the metrics will show up automatically. And right away we can see that OXY does pay a dividend yield of almost 1.5% with a dividend payout of $0.88 per share per year and a very low trailing free cash flow payout ratio of just below 30%, which is always nice to see. Now we can see that the institutional ownership is sitting rather low and that the beta of the company is sitting at 1.58, meaning that the company is quite more volatile than the overall company, say in the S&P 500. We can also see that the current trading price of the company is sitting at $59.48, which isn't that far away from its 52-week low at $55.12. But let's jump to our 9-pillar analysis and analyze the company's fundamentals. So right away we can see that almost all the pillars are sitting in the green except the decreasing shares outstanding. We can see that the 5-year PE ratio and that the price to free cash flow are both sitting at great values, and we can see that OXY has been increasing their revenue, their free cash flow, as well as their net income. Their 5-year profit margin is sitting at 25%, which isn't as great as other companies, but it certainly isn't bad at all. And we can see that their long-term liabilities over their 5-year free cash flow negative dividends is sitting at only 1.73. So if we scroll down to the financials, we can see that the PE ratio has actually been rising over the past 2 years, but over the past 3 years it has been sitting at the values we want it to be sitting at. We can see that the gross profit margin has actually been rising as well, rising from about 29% to about 33% in 2023. Now, the net income, the revenue are both rising, shares outstanding are increasing as well, which I don't really like. But I can see that from 2022 to 2023, they have actually bought back some shares, so that is great. We can also see that the free cash flow is increasing very nicely. The long-term liabilities are decreasing by quite a bit, so that is very nice to see. Quarterly dividend has actually been decreasing when we have a look at the trend, but if we have a look at the past 3 years, we can see that it has been increasing by quite a bit. Now scrolling all the way down, we can see that the free cash flow per share is actually increasing very nicely and that the earnings per share is increasing as well. So overall, the fundamentals of the company are looking very positive. But now let's check out the intrinsic value of the company. So first let's jump to the Grams formula. And here we will use the Grams formula, the earnings per share, the base PE, the 5-year growth estimate, growth rate multiplier, and the yields on AA Corporation bonds to calculate the intrinsic value to be sitting at $80.14, which is 26% higher than the current trading price of the company, meaning that OXY might be slightly undervalued compared to their earnings. Now, a quick reminder, if you find these spreadsheets helpful, you can always support me and download them at my Patreon in the link in the description. But now let's jump to our second valuation model, which is the discounted cash flow model. And here we will take the free cash flow over the past 5 years and calculate a future growth rate of 8.5%, through which we will calculate the future free cash flow over the next 8 years, and then plugging in discount rate at 8.5%, I will calculate the present value of that future free cash flow, and then using our free cash flow method, we will arrive to an intrinsic value of $149.46, which is a lot higher than the current trading price, showing that OXY has phenomenal free cash flow growth rate and free cash flow potential. Now let's jump to our third valuation model, the multiples valuation model, and here I want to compare OXY to its peers, or rather to its competitors, so SUE and CVE. I will take these companies' stock prices, their earnings per share, and calculate their PE ratios. I will then compare the average PE ratio with the earnings per share of OXY and get an intrinsic value of only $39.51. Now what this shows us is that OXY is potentially overvalued compared to companies which operate in the same sector. But remember that this valuation is only based on comparing the company's earnings, and so the overall fundamentals of these three companies might not be as great as OXY's. But now let's jump to our final valuation model, the dividend discount model, and here we can see the average growth rate to be sitting at 79%, but as we can see they have actually decreased and increased by a lot, so I do project a growth rate of 7% into the future year over year, and using our WACC I will calculate an intrinsic value of $66.05. Now moving to our ultimate valuation model, we will use the four valuation methods. We'll take the Graham's formula, which is the earnings of the company, the multiples valuation, comparing the company to other companies in the same sector, discounted cash flow valuation, which looks at the free cash flow of the company, and the dividend discount model, which I will switch to the dividend discount model, which looks at the dividends and the dividend future of the company and the potential return from those dividends, and we will get an ultimate intrinsic value of $83.79, which is 40.1% higher than the current trading price. So say if we plug in a margin of safety of 20%, which is the margin of safety I like to go with, we will get an acceptable buy price at $67.03. And looking back at our data Roma, we can see that Warren Buffett actually bought the company at $64.99, which would be sitting in our buy range. But there are still two more super investors I want to have a look at, and let's start with Terry Smith. So Terry Smith actually reduced a large portion of his portfolio but bought into MTD, specifically adding 7.49% to the holdings of this company to make up 3.18% of the overall Terry Smith portfolio. So let's again jump to our automatic stock screener and plug in the ticker MTD and wait for the metrics to show up. Now we can see that MTD doesn't actually pay out any dividends whatsoever, and I think that this is a very smart decision made by MTD, as they are a company that creates medical equipment, and to create medical equipment, to create new medical equipment, they need a lot of free cash flow to put into research, and therefore I think that them paying out a dividend wouldn't be a great idea, as it would really eat into their free cash flow reserves. Now looking further down, we can see that their institutional ownership is sitting very high, which I very much like, and that their beta is sitting at 1.2, meaning that they are slightly more volatile than the S&P 500. Now let's get straight into evaluating the company's fundamentals. So jumping to our 9-pillar analysis, we can see that their 5-year PE and their price to free cash flow are both sitting above the values we'd like to see. But that doesn't really bother me that much, as I can see that they have increasing revenue, increasing free cash flow, and increasing net income over the past 5 years. They have also been buying back shares, which I love when a company does, and their 5-year profit margin is sitting rather high at almost 60%, with their long-term liabilities of the 5-year free cash flow negative dividends sitting at only 0.66, which means that they can pay off their long-term liabilities in about 3 to 4 years, which is phenomenal, and essentially eliminates potential struggles MTD could have with not paying off their debts. But now let's jump to our first valuation model, the Graham's formula. Again, as always, we'll take the earnings per share, base P, 5-year growth estimate, growth rate multiplier, and the average yield and the yield on a corporation bonds, and get an intrinsic value of $1,062, which is actually 35% lower than the current trading price. And now jumping to our second valuation model, the discounted cash flow model, Again, we're going to take the free cash flow over the past 5 years and calculate the average growth rate. From that, we'll deduce the growth rate over the next 8 years. We'll plug in a growth rate of 8%. I will calculate the future free cash flow over the next 8 years. I will then plug in a discount rate at 8.5% and calculate the present value of that future free cash flow. I will sum all of that up, add any cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $894.99, which is quite a bit lower than the current trading price, hinting towards that MTD might be overvalued when looking at its free cash flow and free cash flow potential over the next years. Now let's compare MTD to its peers or competitors. So I choose A, WST, and ICLR. I took these companies' stock prices, their earnings per share, calculated their PE ratios, averaged those out, and multiplied by the earnings per share of MTD, and got an intrinsic value of $1,328.62. Again, slightly lower than the current trading price. Now we will skip our dividend discount model valuation and go straight to our ultimate valuation, where we will get an intrinsic value of $1,095.43, which is 23% lower than the current trading price. Now if I plug in a margin of safety of 10%, I will get an acceptable buy price at $985.95 or 89 cents. But now it's time to move to our third super investor, Bill Nygren. And Bill Nygren actually invested into a company that I'm the most excited about, and that is PAYC, an online payroll provider. And he actually topped up this position by 181.18%, so that it now makes about 6% of his overall portfolio. So jumping to our stock screener and plugging the ticker PAYC, I will press enter and all the metrics will show up automatically. Now, PAYC does pay out a dividend. They currently have a dividend yield of 1.03%, which gives us a dividend payout of $1.5 per share per year and a very, very low trading free cash flow payout ratio of only 6.56%, which is very, very nice to see. The institutional ownership is also sitting quite high, and the beta of the company is sitting at 1.17, again meaning that the company will be slightly more volatile. Now moving to 9-pillar analysis, we can see that again the 5-year PE ratio and then the price to free cash flow, similarly to the companies we evaluated before, are sitting above the values we'd like to see. But again, we can see that there is revenue, free cash flow, and net income growth. Their 5-year profit margin is sitting very high, and their long-term liabilities over their 5-year free cash flow is on the other hand sitting very low, which I very much like to see. Now their consecutive dividend growth is sitting at 0%, and that is because PAYC only introduced a dividend yield about 2 years ago, and since then they haven't increased it at all. So now let's move to our grams formula, and using our grams formula we will get an intrinsic value of $304.06, which is 52% higher than the current trading price. And moving further to our discounted cash flow model, here I will actually plug in a growth rate of 10%, as I think that PAYC has a good potential in growing their free cash flow 10% year over year. I will also plug in a discount rate at 8%, and by plugging that in, we will get an intrinsic value of $150.70, only about $5 higher than the current trading price. Now moving to our multiples valuation, I will compare PAYC to its peers. I will take their current stock prices and divide by their current earnings per share to get their PE ratios, which I will average out and multiply by the earnings per share of PAYC to get an intrinsic value of $209.53, showing that PAYC is potentially undervalued compared to its competitors. Now moving to our final valuation model, I will actually project a growth rate of 1% into the future. But when I project this low of a growth rate and the company has a higher WACC, the intrinsic value comes out very, very undervalued, very, very low. So we will use our alternative model, where we will use the next year's dividend, the stock price next year, and the WACC of the company, and calculate an intrinsic value of $206.26. Now moving to our ultimate valuation, we can switch the dividend discount valuation to the alternative dividend discount valuation, and we will get an intrinsic value of $217.50, which is almost 50% higher than the current trading price. So if I plug in a margin of safety of say 20%, I would still get an acceptable buy price at $174. Now it doesn't mean that when a super investor buys the company that you should buy the company as well. You have to value the company on your own terms and figure out whether it would be a good addition to your personal portfolio. With that, if you found these spreadsheets helpful, you can access them at my Patreon in the link in the description, and make sure to let me know down in the comments which company you'd like me to evaluate next.